So I'm just going to tell you a little story about how I found out about this kind of stuff, and that's going to be kind of our journey tonight. And then I'm going to show you some specific examples that are setting up right now. I'll show you some trades that I'm in, and then we'll go from there. So this is going to be how I grew in my account just 98% in just 2 months with some little tweaks and some profit accelerator or raters. And I always think this is important. And by the way, when we wrote this copy, by the way, and by we, I mean someone on our team decided like, hey, let's combination, let's decide on this. I can, if people are interested in this, this could really help them. It's like, okay. And so that was kind of at the first week of March. And then since then, it's continued to grow. So this is the account that I use to track the trades in the trading room. And it started the year at $117,000 and $117,000. And then so far this year, have made $152,000 in profits. And if you subtract the commissions that I've paid, because unfortunately trading for free doesn't really exist anywhere for the most part. My balance is now $263,000, so it's a return of 118%. And so my goal is, and my soft goal every year is to start off with a low six-figure account, $120,000, $150,000, and then try to run it up to $1 million. And I try to do that because I tried doing that 3 times when I first started, and every time I failed. I would go from 10 to 100,000 over the course of a year, and this is like in the 90s, by aggressively trading. And then I would try to go from 100 to $1 million, and what was usually within 6 to 8 weeks, I like destroyed my account. And part of it was mentally because $1 million seemed intimidating, but also it was more, I switched from focusing on the setup to focusing on the money. When I'd focus on the setup, the money took care of itself. And then when I started focusing on $1 million, i.e. I'm focusing on the money instead of the setup, all natural bad trading habits came in line. So these days I like to do it as a test, every year to make sure that I'm still aligned. I've still got that going. So anyway, that's my soft goal every year. So the idea with this is that, look, this is not one big trade. I've had a series of trades this year, obviously winners and losers, and the winners obviously are outshining the losers, but it's not been one like, oh my God, did you see that trade? That's why you're up. It's making $1,000 here, $5,000 here. We're currently in a really solid trade in Snapchat, and I can show you that one real quick. I mean, these are the positions I'm in right now. So with Snapchat, we bought 100 call options at $2.28. They're currently $3.45. So that's up $10,000 or $11,000. So that's going to add to my P&L, right? So that's the kind of thing that we're talking about here. So the key with this is to identify and adapt quickly, because one thing I can guarantee you that this year is that the volatility and the uncertainty is going to continue to increase, okay? And you've got to know, like, if the market is trending higher, you've got to have confidence in that. You're not worried about the top. You're like, okay, this market's trending higher, boom, I want to focus on plays that benefit from that. But then you've also got to recognize and understand when the market stops going higher and starts going sideways, because that is a completely different environment, and you've got to use strategies that take advantage of that, or it's going to hurt. And then worse is when the market's rolling over and dying and you think it's a buying opportunity and you just get destroyed when you should be shorting. So those are all things that you just want to know about and be aware of. So that's that. Now what happens is every once in a while I will have a big trade. My biggest one in one day was $1 million trade in 2014. That had never happened before. I've had 6-figure trades, but this was the first 7-figure day trade. And what happens is, over the course, of a year, if I start off with, say 120K, and your trade size gets bigger as your account grows. And so at some point, if I'm putting on, like, say 600 contracts, there's suddenly a potential for something very interesting. And so anyway, it's fun when it happens. But at the end of the day, just going for big trades, that's pretty nerve-wracking. This is a picture I took on Maria and I were out with some friends, and this is not Maria, this is a friend. Um, we went on this we got dared to go on this roller coaster, and this is her name Shelby, and we were on this thing, and this was the what's the thing in Las Vegas, the really big building, the skyscraper, um, what's it called? Whatever it's called. It's the one, but it's 110 stories, and this roller coaster was on the top, and that was genuine fear. So, and you can really feel a lot of those emotions, when you're in big trades like that too. Yeah, the stratosphere. Thank you. All right, so look, this market is, if in trading you're hoping for the best and you just think like, wow, if I'm a good person and I do my due diligence and I put on trades, I'm going to make money, and that's just not true in trading. I mean, that's just getting set up for disaster. It's not just hoping for the best. It's not smoking from the hopium bowl, okay? It's critical to understand how the game is played, and to understand that you got to know how institutions work, okay? You got to know how money flows impact large stocks within sectors. If you don't understand the money flows, you really just, it's just like, I mean, trading in the dark is so cliche, but it's just, you're trading blind. Like that's when if you feel like you get into something and as soon as you get in, it goes against you, that's the kind of thing that can happen. So that's the kind of stuff, and we just got to know that. And so the idea with this is that there are moves out there that I call stealth moves within the key sectors. And if you understand how those work, it's a really easy and simple way to kind of make money in the market. So in general, if you're going to become a trader and you're going to get confident at this and you're going to build up skills that you can use, you've got to do 4 things. You got to learn how to use leverage in a way that grows an account safely and quickly, okay, with the possibility of generating outsized returns. Now you might say, well, John, why do you focus on outsized returns? I mean, a lot of people would be super happy with 20%. The good news is, first of all, twofold. The good news is if you learn how to generate outsized returns, generating 20% a year becomes a piece of cake, okay? It's like if you run a marathon and then after that, walking for 2 miles is a piece of cake, right? Where maybe initially walking 2 miles is tough. It's the same thing in trading. Once you learn how to double or triple an account like safely, making quote unquote only 20% is a walk in the park. So that's the first thing to figure out. The second thing is that as a retail trader, you can do things that funds can't, okay? Notice as a retail trader, you do have the opportunity to generate outsized returns. A fund does not, because they do not have the liquidity. We do, so we have an advantage over funds in terms of that. Develop or utilize proven trading systems and setups as part of your daily money-making routine by shadowing the institutions, knowing when to trade normally and conservatively, and then knowing exactly when to hang on for the big trade. And this is something that is really only learned by screen time. Like I've spent, over 10,000 hours in front of a screen, and over time I've learned what that means and how to identify it, and I can share that with you. That's not something you learn unless you've lived through it many times. Otherwise, it's just a quote. It's an inspirational quote that in real practice is very difficult. And then knowing how to minimize losses when a trade isn't working and what percentage of your capital to put to work. So you want to keep your drawdowns to stress-free levels, okay? So that's the whole key there. You gotta, when you're wrong, and this is a big part of it, when you're wrong, depending on your goals, if this is your equity curve, when you're wrong on the next trade, it shouldn't look like that, right? It could just be like this, and that's fine. Then you can kind of continue. This is very hard to recover from. So that's part of the whole thing. So for those of you that are newer to me, I'll go through this real quick. For those of you that know who I am, I'm going to try to get this done in under a minute. So I grew up in a military family. It's my great-grandfather. He was in World War I. Grandfather Frank in World War II, and my dad in Vietnam. So I kind of grew up in that environment. Wrote a book in 2005, updated in 2012 called Mastering the Trade, kind of just details at least my trading journey and what I've learned along the way. For a while, I went and traveled around the world, did the speaking circuit, the TV circuit, and that was fun. And then something happened. My wife got pregnant and started having kids, and we're just like, man, I'm assuming they're mine. So let's not. I don't want to travel. I want to help take care of them. through the process of doing all that stuff, I've met some of my heroes. I do some work with Richard Branson. It's on Necker Island, and in fact, going there in 2 weeks. And that's been fun. That's been through trading and stuff like that too. So these days it's kids, some charity work, but it's really just trading. Like I said, I like my goals at the end of the year is, this was at the end of last year, can I do it again? And that's my kind of goal, my soft goal every year is to try to do that. And I post my trades and I share them, winners and losers in the room. All right, so I'm not really into complicated option strategies. I like simple strategies, easy to place, easy to manage. I don't do a lot of things like calendars and butterflies. And by the way, they're great. My style and how I was trained as a trader was not options first. It was technicals first. It was money flow first. And so I actually look more at the underlying chart structure. And then based on that, I will make a decision, a directional decision. Okay. And that's one of the things that always used to annoy me is I would go to an options seminar and they'd say, well, if you think this is going to go higher, you could do one of these 17 bullish strategies. And if you think it's going to go lower, you could do one of these 17 bearish strategies. And I would just raise my hand and say, well, what signal do you have that something's going to go higher or lower? And no, it was just like, crickets. And I was just like, there's got to be a way to kind of get a very good odds on that this is going to go higher or lower instead of just sitting there doing iron condors all day. So then the idea with that was just, that's been my path. And I've always been fascinated and obsessed with the idea of being able to accelerate returns with tweaks, okay? And that's really fun that you can do with options. So no need in trading to look for the next needle in the haystack. No need to find the next $1 million Tesla trade. It's great when it happens, but you can't plan for that, okay? You cannot plan for that. So to understand all this, you need to know what the big money is doing. Are they day trading? Okay, no, the big funds are not day trading. They leave that to the high frequency traders. Okay, and by the way, the margins for the high frequency traders are going down. It's not as lucrative as it once was. But at the end of the day, though, that's not what the funds are doing. They're not even competing with the high frequency traders. Okay, so why should we? My biggest advice there is just ignore all time frames under 5 minutes. Those are dominated by the machines. Whether you're trading S&P futures or a stock, machines own those time frames. Don't compete with them on that. If you're day trading, great. Do it on a 30-minute chart, and just stay away from those. So then the question is, okay, great. What are the funds doing then? So this is kind of the path I went down with this, and it was just kind of fun. So the big money is all chasing the same stocks for one simple reason. It's just that they have no choice. Believe me, if they could do something different, they would, but they have no choice, all right? These are the 10 main ETFs that make up the S&P 500. XLY, that's consumer discretionary. XLF, that's financials, et cetera, et cetera. They represent all the key sectors, okay? And that is what drives the fund returns. It's rotating in and out of sectors. It's not like the good old days where a fund would believe in a stock. Hey, Microsoft, that sounds like a good company. Let's buy it and let's hold it for the long term. No, that does not happen anymore. It is about sector rotation. It's like, okay, financials are in favor. We're going to pour all of our money into financials, and then as they kind of peak out and they get to a PE multiple that we're not comfortable with, we're going to sell that and then go into consumer cyclicals and stuff like that too. And that's what drives the return. Now, most funds are too big to own more than 1% of an individual stock due to liquidity. So if they're going to get out of financials, right, and then go into tech, then what's going to happen there is they're not going to sit there and say, okay, let's just dump all of our Goldman Sachs and then buy Apple. What they're going to do is they're going to, dump XLF, and then the XLF ETF through that program trading is going, it owns like 100 stocks. All 100 of those stocks are going to get sold to varying degrees, and then they're going to go into technology. And so that's kind of how, the real world works in terms of trading. And you can see here in terms of returns, you can see the rotation here. Okay, so if we look at, say, the latest quarter where consumer staples are up 9%, energy was down 3%. Okay, money's rotating into staples out of energy, and more money's going into utilities here. Year to date, though, or last year, it was different. Money was going into financials, okay, and out of consumer staples. And so that's just how they play that game, and it's just rotated over and over and over again. So the thing to keep in mind here too is that the way these sectors are set up is that there's a lot of money chasing not only a handful of sectors, but a handful of stocks within those sectors. Okay, so you got technology makes up 24% of the S&P 500. Okay, financials makes up 15%, healthcare 14%, and then consumer 12%. And that's 65% of the S&P 500. Okay, that's crazy. So you've got a lot of money chasing a handful. That's where the liquidity is in terms of those sectors. Okay, now this gets even better. Within these sectors, okay, just picture this. Within the sector, there's like 100 stocks. Well, guess there's one stock in this sector that makes up like 12% of the sector, and no surprise here. So you're gonna have like Apple. Okay, you're gonna have Apple there, and then then you're going to have like Microsoft, right? And then like Facebook, and then after that, it's just a bunch of other stocks. And so guess where the money is going to go into with those stocks? And that's why I like to keep an updated list of the top holdings here. So for financials, even though there's like 100, technology, which makes up 24% of the S&P 500, even though there's 100 stocks in there, Apple makes up 15% of that, and Microsoft another 10%, and then Facebook, then you got AT&T, and then Google, and then after that it drops off pretty fast. Okay, you got a lot of stocks that make up 1%, 0.25%, etc. Okay. So just things like that you want to keep in mind, what the top stocks are. So why is this important? So when institutions are rotating into one sector and out of another, which stocks are going to get the most action? Okay, the smallest stock in that sector or the biggest? So this is what's kind of fun here, is that when you look at the stuff and a sector starts to go, okay, here are financials. On Tuesday, we're down 2.89%. Okay, Goldman Sachs, which is a top 10 holding in the sector, was down 3.77%. All right, versus T. Rowe Price, which is like 0.32% or 0.66%. What is it? 0.57%, was only down 0.95%. So what happens is when XLF sells off, the top 10 holdings sell off generally at a greater rate, okay, because they're the most liquid. That's where the money is forced to go. And the same way to the upside, it's going to be the top 10. So there's a lot of money chasing fewer stocks. That means they're going to have bigger moves. All right. And on Tuesday, when financials were down 2.93%, you can see here that except for Berkshire Hathaway, which is a financial, but it's also very diversified, most companies were either down the same, i.e. JP Morgan, or much more. Bank of America down almost 6%, okay? And there's always exceptions, but in general, that's where the action is going to be. So, so goes the sector, so goes the top 10 stock in a big way, okay? So this got me to thinking. Is it the indexes that drive the sectors, all right? Or is it the sectors that drive the indexes? And then drilling down from there, is it the stocks that actually drive the sectors, or is it the sectors that drive the stock? And so this was a question that I had, and I wanted to obviously get the answer to, because it was just like, all right, what's going on here? So for those of you that are, I guess, newer to at least my style of trading or what I do and what I look at, a big part of what I look at is called a squeeze. Okay, and so what is a squeeze? Well, I'll show you the S&P 500 right now too. So a squeeze, you can see there was 2 squeezes here today for a chart. So it just see these red dots right here. It just represents a moment in time where there's consolidation, and so it's building up energy. Okay, just think of it as compression. And it's much like an Olympic athlete. After they run the 100-yard dash, they don't immediately go run the 200-yard dash. They sit down, they rest, they relax, they get some electrolytes, and once they're built up their energy again, they go run another race. And it's the same way with stocks. So you've got a squeeze here, it's built up energy. This first green dot represents selling, right? So that's negative, and then it's going to fall until that switches. And you can see here's a long squeeze, the other way. So that's the squeeze. You can see this real time. It looks like the S&Ps right now are up 8 points, healthcare bill or something's going on. So, and like here's Tesla. This was a great trade we did earlier in the year in Tesla. We've rallied, we're consolidating, we built up energy, and then boom. So what I wanted to do is dive in and say, all right, well, how does the squeeze impact all this stuff? So, when I'm looking at these charts here, and we've got Facebook, and we've got, here's Facebook, and here's XLK, which is technology, and then there's the Qs, which is the index. So you got stock, sector that it trades in, and then the index, the main index. Okay, and obviously XLK is technology, is S&P 500, but the Qs obviously are very heavy tech weighted. So we can see that each market has its own squeezes. So Facebook on the 30th had a squeeze, okay, but XLK on like the 15th had a squeeze, and then the Qs on they had a squeeze here, and so they had these squeezes on different times. And so my question was, well, how much did these squeezes impact each other, and are there ever times when they all squeeze together, and if so, is that a bigger move, okay, or not? So then my question, here's my original thought, is that it would make sense that the biggest moves happen when an index, okay, like the Qs or the S&P 500, i.e. spiders, or NASDAQ, make a move, and, i.e. squeeze, a sector within that index, for example, XLK, also sets up as a squeeze, then one of the top 10 stocks like Facebook, et cetera, in that sector, if that was also in a squeeze, would all those three together, like tripling up, make an even bigger move than normal? So if we look here at this, you can see that you've got the spiders, you've got XLK, which is technology, you've got Facebook, and the spiders and the Qs can be kind of interchangeable. I mean, I watch them both, but you can see like, wow, here's a squeeze, look at that big move. Here's a squeeze, look at that big move. Here's a squeeze, look at that big move. And these squeezes all happened at about the same time. Okay, so it's like, okay, and that makes sense if you've got an index and a sector within that index, and then one of the top 10 stocks within that sector all squeezing at the same time, then it makes sense that that's going to be the biggest move. So it wasn't a big shock. Okay, it wasn't a big shock. I just wanted to confirm that. So, and although it can be hard to find when an index, a sector, and corresponding stock are all in a squeeze together, especially on lower time frames, like a 30-minute chart, when they do line up, they're powerful. Okay, so, but it just doesn't happen a lot. So I started thinking about, well, what about just a stock and a sector together without the index? Is that something that happens more often and offers more flexibility? And it's like, all right, so as I started looking through this and said, all right, well, here's XLF, that's the financial sector, and here's Berkshire, which is the biggest holding in the financial sector. So it's like, all right, you can see here's the date, October 31st, there's a squeeze, October 31st, there's a squeeze. And when they go together, that was kind of like the biggest move. It was a really big move, right? And so that was great. And then, so that made sense too. And I was excited about that. I was like, okay, I'm gonna start finding instances where that happens. So when, because what I found with this is that there's times that even when the indexes, like the S&P 500, like, oh my God, this is a choppy day, there's times when like maybe the financials, the sector has a squeeze, and like Goldman Sachs has a squeeze, and it has a really big move, even though the stock market is trading sideways, okay? So that's one thing to be aware of, is that even if the stock market is trading sideways, all that means is that 9 of the 10 sectors are trading sideways. One could be taking off. So that's what happens on a day where, maybe financials are up good and energy's down and everybody else is not doing much. You get choppy indexes, but boy, you get a really good move in the financials. So it's telling you where to be. It's telling you where money is going, okay? So this is then the next question I had, is that what happens when a sector has a squeeze, but one of its top 10 holdings does not have a squeeze? Okay, so this is where I wanted to find out the answer to the question of what's more important. Is it more important for a sector and a stock to have a squeeze together? Or is it more important for a sector to have a squeeze? Or is it more important for the stock to have a squeeze? And I didn't know the answer to this. So I said, let's take a look. So here you can see that there was a squeeze in the financials, but there was not a squeeze in Goldman Sachs. But when the financials went, guess what? Goldman Sachs is a top 10 holding, went 2. Okay, so that's a stealth move. Those are fun because they catch everyone off guard, and you can typically, through buying call options, make the most amount of money here because it's kind of out of the blue. Nobody was expecting it. Okay. And by the way, when nobody's expecting a move, that's when the options are what? Super cheap. All right. So here's a quiet market. It's, it's no excitement, nothing interesting. Well, that's when the options get cheap because there's nothing going on. And that's why you could buy the options cheap. The stock, as it starts going up like that fast, obviously your call option expands in value, but the premium expands in value as well. So it's kind of fun. So this got me interested in focusing on sector setups and then placing trades on one of the top 10 stocks within that sector. So what I did here, and some of my best trades this year have been on Priceline. So here is this is XLY. That's a consumer sector, right? And you can see here when this consumer sector went, okay, Priceline went too. And so what's the lesson with this? The lesson is know your top 5, okay, or know your top 10. So Priceline, if someone asked me if I didn't know this already and said, hey, Priceline, what sector is that in? It's technology, right? Well, guess what? It's not. It's in consumer discretionary spending. Priceline makes up almost 4% of XLY. What's the number 1 stock in there? Amazon. Okay, now to me, they're tech stocks. But why this is important for you to know is that when XLY has a squeeze and fires long, the institutions are forced to buy XLY, and then when they're buying XLY, that fund has to go and buy those stocks, and guess what the top holdings are? Amazon, here's Home Depot, Comcast, Disney, all right? And so they go. So I thought that was a pretty awesome kind of a thing. So then I started thinking about this. How powerful is a stock by itself, okay, when it does not have an index to back it up? Okay, so here is Facebook. Okay, I like to trade Facebook. Here's a squeeze on Facebook, and you can see it really did nothing. In fact, if you bought a call here, you lost money because it went sideways. And then I said, okay, at this point I called Eric. If you guys don't know Eric, he's a really, really good ninja style think scripter coder. And I said, look, I have a dream. I want to be able to look at multiple sectors and indexes at the same time on multiple time frames and compare them to the stock I'm looking at to see if anything is setting up in a squeeze together. Because this has taken me forever. I'm having to look at thousands of charts, waste thousands of hours looking at all these different things, trying to find a needle in a haystack. And Eric said, give me 2 weeks. And this is what he came back with. So remember that Facebook squeeze, it didn't work. So Eric came back with this amazing tool, all right? And it's, the triple squeeze here. And you can see what it does. It just tells you, you can pick up to 10 different things. Is there a squeeze or is there not? So here's a squeeze on Facebook. And if we look up here and you can see what's in here, there's the spiders. Is there a squeeze on the spiders? No. Squeeze on the Qs? No. There's a squeeze on IWM, right? That's not going to really impact Facebook. Is there a squeeze on the transports? No. There's financials? No. XLK, that would be important. Is there a squeeze? No. So it's essentially, there's IWMs in a squeeze on this time frame at that particular time in energy. Okay. Who cares? Facebook squeezes, nothing. Now let's compare that to Facebook with another squeeze on the same time frame that has some support behind it. Okay, so here's another squeeze on Facebook. We got the squeeze, and now as we go down, we say, wow, there's a squeeze also setting up on this time frame in the S&P 500. There's a squeeze also setting up on the Qs. Okay, there's a squeeze also setting up on XLK, as well as a couple of other ones. That's good. And we can see that when it had this kind of triple power behind it, the move that it made here compared to the other time. Okay, and so that's what I was like, oh my God, that's great, because what will happen is like on a squeeze, it's like, all right, yeah, the squeeze will work 75% of the time. That means 25% of the time it won't work. So if we can not only two things, one, eliminate as much as possible the 25% of the time that won't work, and just pass on those trades. But two, understand that when there's like a triple squeeze potential like this, the potential that this could be a much bigger move, we want to, so in the one hand, we're avoiding trades that don't necessarily going to work that great. They'll be okay, but not great. And then on the other hand, identifying the times when it's got the highest probability of working the best and making a more aggressive bet. So here, I would say like, okay, I'm going to buy 10 call options here, right, or whatever, or buy the stock. Here, I would just say like, well, I'm not going to buy call options. I'll sell some put credit spreads for some income because, you know, it may go up a little bit, but it's not going to go up much. And if it trades sideways, I still want to make money. All right, so that's been super helpful. So, you know, this might be 2 trades on Facebook that both make money, but this one, because it's 10 call options that, you know, go from $1, you know, $1 up to $5, you know, on something like this, I make $5,000, and I'm selling a 10-lot put credit spread over here, you know, for $1. I make $1,000 or whatever, you know. So that's just kind of the difference there, and that's kind of fun. Now, so for those of you that are familiar with our indicators, we've got one called the multiple time frame analysis tool. So they look similar. They are nothing in common. So what this does, just so you guys know, if you have this one, is that this one is saying like, hey, this is a daily chart, and this is just looking back, and it's just saying like, hey, if it's green, it's bullish on the daily chart, you know, the 2-day chart, the 3-day chart, the 4-day chart, and the weekly chart. Great, it's bullish in all time frames. This one is saying, hey, on this time frame, is there a squeeze or not? Green, there's no squeeze. Red, there is a squeeze. So they look alike. They are completely, totally different. You know, just in case there's any confusion there. They don't measure the same thing at all. So I got very excited, and with this tool, I can now look at up to 10 indexes and sectors of my choice as I'm moving through my stocks, and I can do this on any time frame. Okay, it's not just, oh, let me set up the weekly. I can flip to a 30, flip to an hourly, whatever, and I can see it very, very quickly. And I can quickly see where the focused action is going to take place, which is great. So now I can play by the institutional rules, and I wanted to get a sense of you know, when this happens, when the institutions line up, I wanted to get a sense of the average length of the move. Okay, so when the institutions line up, where is the move going to the upside for long plays and to the downside for short plays before the funds pull back the gas? Okay, because they're stepping on the gas and then they're going to pull back on the gas. They're not going to, you know, nothing goes straight up or straight down forever. So we're going to get a sense of what are they doing. It's all math. Institutions are all math. What math are they using for this? And so one of the things I've always been fascinated by are average to range moves, okay? So you got average to range, and I'm a big fan of standard deviations, and this is the math that the funds use to gauge this, all right? And so I want to know what math. So if they're going to do standard deviations, and by the way, if you don't understand standard deviations, stuff like that, don't worry. But so what'll happen is the standard deviations are for each week based on options. So, you know, for this chart of Amazon, you can see that, you know, this was taken on Tuesday, that was the standard deviation for the next 3 days. And then these were the standard deviation levels for next week. And what I found quite by accident is that the moves would typically test the one standard deviation level of the next week, okay, not this week, but of the next week, which I did not know, and then terminate. Okay, Amazon came up here and touched it exactly before rolling back down. And I just thought that was pretty fascinating. And you can see on Tuesday, a lot of these stocks, XLK hit that one standard deviation level for next week, and it was done. And if you'll notice the way these things move, okay, it's like, you know, they'll pop up and they hit some kind of level and then go back down. It's because they're hitting this level. All uptrends and all downtrends are dominated by these one standard deviation models that funds use to manage when to buy and when to sell. So when you combine these two together, it gets very, very interesting. So now, like for NetEase, it's like here's the levels and here's the signal. And if there's a signal that we like, we know, like, okay, if we know, we can plot out our targets in advance based on where we know that the institutions are going to let off the gas, which can be fair, you know, very interesting. You know, if we look at say the NASDAQ futures right now, and the NASDAQ futures are up about 16 points, and, you know, we don't know yet if this thing is, you know, there is a squeeze here. Now, this squeeze has not fired yet. Okay, so it's either going to fire long or short, and we don't know yet. And we're right here at the 21. If it fires long, guess what? We're looking for a fairly substantial move up to that one standard deviation level. et cetera, et cetera. So, and you know, if you want to go over to the Qs, all right, we can see here on the Qs, same thing. Like, wow, this is setting up. If this triggers long, we're going to look for it to go up to this level. If it triggers short, we're going to look for it to go to this level before the funds turn off the gas. So right now we're waiting. So by the way, during this phase, we could do what? We could buy a straddle, okay, if you're familiar with options, but I like to wait and see which way it's going to go. So anyway, to me, that was pretty good. So the final piece of the puzzle of all this is that what options work the best, okay? What options, you know, when you see something and say, all right, okay, this is great, you know, this is working, and what kind of strategies would you use? So you can see this is from my P&L is that, you know, I've done like, I don't know if it's like 7 or 8 trades on Priceline. Okay, so when you see this, that's your cumulative P&L by ticker if you're doing this in Thinkorswim. So that showed $49,000. It's like, okay, great. And $46,000 in Tesla, and you know, blah blah blah. So you know, I didn't do 1 trade in Priceline. I did 7. And I've traded Priceline frequently. And the reason I'm doing this is because 1, I'm watching I'm watching its sector, XLP, but I'm also have learned kind of accidentally, but now this is something I want to share with you guys as well, is that with some stocks, even if you've got a bullish setup, okay, it's like if you got a bullish setup on Priceline and a bullish setup on Tesla and they're the exact same setup, do you use the same option strategy? And the answer is no. If you buy a call on Tesla, you're most likely going to make money on that long setup. But if you buy a call on Priceline and that's it, you're most likely going to lose money even if it goes up, because the premium on that stock is ridiculous. So this is what we did on back testing it. And you can go through and say like, okay, if I just buy calls, if I just buy calls on Priceline, I'm going to lose, you know, deep in the money calls, I'm going to lose 16%. If I go delta 60, slightly in the money, I'm going to lose 2%. Then, of course, if I buy real far out of the money options, I'm going to lose 47%. Now, if I take that same setup and say, okay, you know what, I'm going to buy calls and sell some puts, then all of a sudden you can see instead of losing 16%, I can make 139%, okay? 107% if I'm doing, you know, if I like to buy the delta call and sell the 50 delta put, and you can see that, I mean, look at that difference. It's insane. Same setups, right? Just a slightly different option strategy. And so that was nice. So at the end of the day, I mean, when you got the right strategy, you're going to have an equity curve that looks like this. And the goal is on days when the market's against you, okay, when the market's not doing what you want, you have small losses. It's a trader's job to take small losses. And then when you nail it, your equity curve grows. And then from here, instead of, you know, making mistakes and watching your equity curve go down, you know, you kind of piddle away here and there, and then you catch the next big move, right? And so that makes it, that does that too. So at the end of the day, and it's about the power of teeny gains, okay? And if you can get your trading even 1% better every day, and sometimes that's adjusting your setup and adjusting your entry, but you know, utilizing the right option strategy, your versus 1% worse every day, you can see the difference here. Okay, it's a huge difference starting from 0. I mean, it's a huge factor. Whereas if you're getting 1% worse every day after the end of the year, you're almost back to 0. I mean, you know, you're down. Whereas in this case, your account goes up by a factor of 3. So it's a big deal. So at the end of the day, I'm a big believer in trading. Like when I say like, okay, I'm going to try to run my account up to $1 million, right? And what do I do then? Well, I take money out. I buy land. I'll buy artwork. I'm just a big believer that trading is a skill. You develop that skill, and then you get those profits away from the market makers and put it into tangible assets. Okay, so that's what I do, or that's what I look at. And so what I was going to do is on Saturday, I'm going to teach a class on Saturday and do some live trading. For those of you that are interested in the stuff that I talked about, this is pretty awesome. I'm going to do a 2-hour class on Saturday for just $47 for those of you that are newer. And I'm just going to talk about a lot of the basic stuff that I like to do. Okay, this will be like from 9:30 to 11:30 Central. If you can't make it, it'll be recorded. What happens is after the class, these prices go up, so you guys can lock in even if you can't be there live, you could lock it in and get the recording. And I'm going to go over things like the squeeze in detail, how to use it, how to find it, how to manage it. Okay. And again, this is for people that are, if you're a little newer to trading, or you're newer to Simpler, or newer to me and you're not really sure, this is kind of your starter kit. All right. These are all the basic tools that I like to use. I'm going to go through and show you. Now, if you were interested in what I talked about tonight, I'm going to teach this strategy in depth from noon to 5 on Saturday. Okay. So what this includes, a couple of things here, kind of a couple of key points. So this includes the starter session. It's a 5-hour strategy class where everything we talked about tonight, we're going to go through in detail with checklists. Okay. So what to do exactly and when and which stocks to use, but also it includes this triple squeeze indicator, okay, which is pretty awesome. And then if you are interested in live trading, okay, we've got this professional package, which includes of course, the Saturday class and the starter kit. And you get the triple squeeze indicator, but you also get the expected move indicator. Okay, these are two very powerful tools. And we do 3 days of live trading and Q&A follow-up. Switch those. So that's nice. And the live trading is fun. The last 12 classes we've done with live trading in one lot, everybody's been able to pay for the class with the profits from the trades. So that's awesome. And that's a fun way to do it, kind of earn while you learn kind of a thing. But the live trading part of it is nice because I always equate it to, if you're trying to learn how to play golf, you can read a book over the weekend and then, you kind of get the idea. And then when you show up at the course on Monday, ready to hit, it's like, wow, it doesn't work. And it's because you need that, you got to practice it. You got to actually swing the club, and you need someone there going like, hey, you need to loosen your grip a little bit. Someone who knows how to golf. And it's the same way in trading. You can read everything you want to know about trading, but in real life, okay, trading, looking at a PowerPoint in hindsight, that's pretty easy to trade. It's pretty easy to say, yeah, I should have gotten out there and gotten in there. But in real life, in the heat of the moment, it's not that obvious, okay? And that's the kind of stuff that you learn in a live trading environment. And that's why, and I trade my account live. I put my money where my mouth is. I have no problem showing you winners and losers. And I just think it's good to know. It's like, all right, wow, we woke up and the market's not doing what we thought. What do you do? Okay. Do you just sit there and wait like a duck to get shot? Do you wait for, you just wait for your stops to get hit? Or are there ways to get out before your stops hit? Are there signs to look for? That's the kind of stuff that can really give you an edge. And so anyway, that's a lot of fun there. And then for those of you that like live events, we are going to do our annual live event in Austin in June. And that, of course, includes all of this. And live events, it's one of those things where it's either for you immediately get that, it's like, okay, that makes a ton of sense, or it's not. And for a live event, it's like, okay, look, you're going to get on a plane, you're going to come to Austin, you're going to be in a room for 2.5 days with other traders. We play poker together at night, have a poker tournament to learn money management. You form bonds and friendships with other traders, and most importantly, because you're consciously stepping out of your environment and you're immersing yourself into the topic, you start to have connecting dots and realizations that you never would have before, simply because of the focused concentration. So a lot of times the things that you learn in a live event like that are things that are unsaid. It's just you're just there and you're focused and you're able to make connections. And so that's always fun if you're into that. So that's what I'll be doing. And then let's hang out for a bit. I will answer questions. If you go to simplertrading.com/shadow, there's a whole page there that details this, and there's a lot of details, so you can read through it and all that kind of stuff too. All right. And then if you do have questions, I'll put our number up here for the office, and then I'm just going to hang out here and answer questions. So we're in Austin, Texas, 512-569. No, that's I did it again. Gosh, 266 8659. Okay. All right. Let me see what questions you guys have. And then let me get. Let's see here. Okay, guys, I'm just going to scroll through this, and I'm also looking for Dun, 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 dun. Oh, there it is. I was trying to find my Skype as well. Okay, so okay, I signed up for the starter course. I've been listening to for a year. Time to go into the pool with the sharks. No, that's awesome, Philip. And I always say, and the reason the starter course is just that, because I think, especially if you're newer and things like that too, it could be intimidating. You know, you don't know if this is going to be for you. The starter course, you're going to get a ton of value. You're going to have tools that you can start using your trading right away, and I think that's awesome. You mentioned the triple squeeze indicator was customizable for symbols. Yes, so for the symbols, it defaults, you know, we preload 10 for you, but you can change them to however you want. So guess what, you know, you could do is you could have a couple of different, you know, you could have a couple of different charts. You could say, okay, you're going to list chart XLF and then have the 10 largest components below it. I mean, so yeah, it's definitely customizable. And then the time frame, well, the time frame is just whatever time frame you're using. So if you're looking at a 30-minute chart, all 10 of those are going to be turned to 30-minute charts. And that was a request that I made because I'm like, you know, I'm going, you know, if you're looking at a weekly chart over time, you can sit there and go, oh, okay, this weekly squeeze and this is a weekly squeeze because they take a long time to form and you can see it. But a 30-minute chart, you know, the squeeze is set up in a couple of hours and I got to be able to see them, you know, quickly in order to take advantage of it. Yeah, oh no, good, Ralph. Glad you liked it. John, I took the SPY live trading package correlations. How big it? Yeah, no, Anthony, I'll definitely be talking about. I mean, because here's the thing, and I think you know, we've had an uptrending market for so long that look, most of the live trading we've done over the last couple of years is focused on bullish trades because that's what we're getting. But I think it's important in this environment to understand how to use these indicators for sideways trades, how to use these indicators for bearish markets and bearish trades as well. And I think we're going to get into that. I mean, that's the kind of environment we're going to get into, so that's why I want to talk about it. Is the one standard deviation the same as the one ATR? So it's not. The ATR is based on the average true range, which is based on the actual average price movement of the stock, whereas standard deviation is based more on a volatility calculation. So they are actually different readings. From your perspective, what does the launchpad indicator do versus the triple squeeze indicator? Okay, so that's a good question. So the triple squeeze, so I use the launchpad indicator on the stock. So if we're looking at the stock with the squeeze and you've got the launch pad, that's telling you that there's a lot of action in that stock, okay, which is great. And then what the triple squeeze is doing is that, by the way, there's a lot of activity in the stock and there's a lot of activity in its sector and there's a lot of activity in its index. And so when that situation comes together is when I make the biggest bet. And if I'm trading the stock as a standalone, you know, I want to see that launch pad, like, okay, is there at least some action coming into this? Do the indicators work only on Thinkorswim? So right now we've got them programmed for Thinkorswim and TradeStation. Now, for those of you that don't have those platforms, it's fine. We also are putting them into a web-based scanner that we have. So you have different things like that. So don't worry if you don't have, like, oh my God, I don't have Thinkorswim. It's not a big deal. Yeah, and we can get you. Oh, so what questions are in each? Yeah, what stocks are in each sector? So yeah, the stocks that make up each sector is not a big secret. You can go to Yahoo Finance and stuff like that too. And certainly during the class, I'll give you all the resources and things like that I use. Will there be other options available for the live trading days? The work schedule is already committed for the days you have listed. So Jay Daniel, so good question. So for this class, it's, you know what, that's a really good question. I'm just thinking off the top of my head is that for this class, I mean, that's kind of when we're going to do the live trading, but we do other live trading in the future. So, if it's something that you're interested in, you can talk to support and say, hey, I like this. I just can't attend this live trading. Could I do the next live trading, which might be, focus on some different stuff. So I don't know. Nobody's asked us that before. One thing that people will do is if they can't go to the live trading, they'll sign up for it. We have done alerts in the past when we're taking a trade, but then of course you can watch the recordings. So I would call. I mean, that's a good question. Long volatility and long Goldman Sachs good hedge. I think that's a good hedge. I like it. Does this work for futures? Yes. So for futures, what's great about futures, if you understand the correlations there, if you're trading the S&Ps, you can guess what? You can put in the in the triple squeeze section, you can put the yen futures, you can put the euro, you can put gold, you can put bonds, you can put oil, put crude in there. And now you can see squeezes on all the correlations, which is pretty awesome. Ern, how did you do the options trade structured backtest? So I found a couple of tools for that, and I'm going to go through. So part of Saturday is like, look, these are all the tools that I'm using for this, and so I'll have all the lists and stuff like that, so I can get you guys that stuff, because it's one of those things where it's nice. It'll take forever to do it, say on on a platform, but you can do it fairly quickly. It's like, oh, look, here's this place that does it. Is this strategy / professional class included for current members of simpler options? In other words, do members miss something if they're not signed up? Okay, that's a good question. So if you are a member, this class, so the membership is for our live trading room and newsletters and forum and stuff like that. And so this class is separate from that. So you would definitely want to sign up for the class. So that's a good question. If you're interested in it, for sure. John, how much influence do futures have in the process? Well, I always like to know what the correlated assets are doing. Okay, what is the yen doing and things like that too. And I'll talk about that a lot on Saturday. But what I have found is that in the stock market, how there's some days when the correlations don't make any sense. It's like, okay, bonds up, stocks down. Well, why are bonds up and stocks up this time? Well, it's because XLF fired long and money's flowing into the financials. Okay, so I have found that the sectors are responsible in a way for the decoupling of the stock market with a lot of the other asset classes. Let's see. Yeah, and a lot of these things, so good question. The sector and indices were in squeezes also, but not fire long. So a lot of the times these things will roll. So, if you got 3 that are set up as squeezes, sometimes they'll all fire at the same time, which is great. I like it when they roll, meaning like, okay, like say, the stock triggers one day, and then the next day it's the sector. Okay, and when the sector goes, the stock has an even bigger move. And then the next day, finally, the index goes, and this thing even has a bigger move. So, and that's kind of fun too. All right. John, on your Goldman Sachs example, did the other financials explode out of a squeeze? Yeah, so what was interesting on that financial one is that some of them, like JP Morgan, were in a squeeze, and then some of them, like Goldman Sachs, were not in a squeeze. And what I was fascinated by with that is that it just told me that the sector was completely driving all the stocks. So it's so important to know and track the sector itself when it's in a squeeze. And if you get a sector and a stock together, and that's a bonus, that's great. But it was just clearly understanding that when a sector goes, okay, those top 10 holdings also have to go as well. And that's kind of that stealth move. What's the best time frame? So the nice thing about the time frame is completely adaptable to your personality and work schedule. If you work full time, you're just going to be looking at daily and weekly charts. You obviously are not going to be messing around with 5-minute charts. If you are a full-time trader, like I said, I don't recommend 1-minute charts and 5-minute charts, but if you're a full-time trader, could you look at, and you're looking for, I want to be in a trade that lasts a couple hours, great. You could look at the 15-minute charts and the 30-minute charts and things like that too. So here's the thing. with with indicators. I mean, not with indicators, with time frames. The power of the move is actually the same. It's like with a squeeze, the power of the move is the same. It's 8 to 10 bars. So on a 5-minute chart, 8 to 10 bars is about 40 minutes. On a weekly chart, 8 to 10 bars is about 8 to 10 weeks. Daily chart, 8 to 10 days. So you pick the time frame that just fits your schedule and personality best. That's the beauty of it. So a weekly signal is going to have a much bigger move than a 5-minute signal. The 5-minute signal is going to last like 40 minutes and it's done, while the weekly signal is going to last like 8 to 10 weeks and then it's done. John, I'm making the switch from a failed stock-based approach to options, and I'm new to options. Which package would you recommend? If you're not sure, I would just say start with, do the starter. The starter is like the no-brainer. If you're newer to options or newer to simpler, the starter, there's going to be a basic philosophy, kind of a soup to nuts of my style of trading, and just talking about like, look, this is what I look for. This is when this happens. This is the kind of options that I'm using and things like that too. And at the end of that, you're going to have actionable items that you can use. Okay. Specific setups, specific chart layouts, and things like that too. And if you like that, at the end of it, you can say, well, I like that. Now I really want to learn, I want to dive into this new strategy and I'd like to get the copies of the indicators. Great. You'd have the opportunity to actually do that if you wanted to at the end of the class. But I would just say, if you're standing there going like, this sounds interesting, I'm not really sure. Yeah, you do the starter class. So you're not doing iron condors. I do iron condors. Okay, that's a great question. I actually like iron condors, but what I'm doing is that when you have a triple squeeze lined up, that's the last thing you want to do. So when you're doing iron condors, and like if you're doing a 1 standard deviation iron condor, 8 times out of 10 it works perfect, and 2 times out of 10 it's a headache, right? This tells you when to not do iron condors. Like if you've got a triple squeeze, don't do an iron condor because one side of your leg is going to get blown out of the water. So that's one thing. It kind of tells you when not to do an iron condor. But guess when the best time to do an iron condor is? When you look at that triple squeeze and it's all green. Okay, nothing's in a squeeze. That means it's quiet. That's when you want to do iron condors. How do you protect your downside? So the best way is through position sizing. So I'm always a big believer of like, just determine what's the most you're willing to risk per trade. So if it's $1,000, great. Don't buy 10 options at $10 because if it goes down $1, you've lost $1,000. So I'm a big fan of position sizing, using a specific strategy with the average true range. And so my position size will actually differ based on that. And so if I have what I call a setup in a triple squeeze, then I'm willing to risk more on that because of the higher probability of success and the higher potential reward than say like, oh, okay, there's only one squeeze setting up, so I'm going to trade half size on that one. The expected move indicator shows you where the institutions take their foot off the gas. Literally what happens is that the institutions actually sell a lot of those options and sell options outside of that move. So if you get up to that move, they actually want to defend the stock and push it back down so that the options that they sold expire worthless. Can this be used for futures? Absolutely, yes. Yeah, Rob, and that's a good point. It's really good too. Yeah, it works great with the voodoo lines and stuff. Bill, what I would suggest is that if you've already got plans for Saturday, which is completely normal, it's normal to have plan. Hey, I got something planned for this weekend. Is that these classes like this, they'll come up and we'll do them once, and then there's a recording if you'd like to get it. What happens is after the class, the price goes up. So I would encourage you, if you're like, okay, this looks actually pretty interesting, is get it now, lock it in, and then you can just view the recording. a little bit later. Afterwards, usually the price usually goes up to like 697, like after the class is done. So we always try to say, hey, if it's something that you want, we encourage you to certainly sign up for it, and the recordings are readily be available very quickly. Oh, from Trade the Markets. Oh, very nice. Yeah, a screenshot of liftoff. Sure. Let me let's see, where is it? So, if you look at the Qs right now, you can see they're building up some momentum. That's what I was talking about here. If you look at, what's another one that the spiders. So the spiders, you can see that they've got some, lift off there. Now, it'll be interesting to see tomorrow where we open up. I mean, S&Ps tonight are up 8 points, but you can see all that's happening right now. And right now we're just kind of moving back up to the 21 period moving average. And my contention is once you're below the 21, it's a downtrend until proven guilty. Okay, meaning you'd have to close back up above the 21. So tomorrow will be pretty interesting, just to kind of see how it all shakes out for sure. Oh, is there a topic list for the starter session? So the starter session is really just going through my basic philosophy kind of stuff. I'm gonna, I'll go into the squeeze in detail, like how it works and why. I'll show you how it's constructed. I liked how I use things like the ATR and moving averages to time trades and the managed trades and the managed targets, some basic Fibonacci extension work and things like that. So at the end of this, you have a process with which to trade, and it's plenty, and it'll be plenty. I mean, and if after that you're like, okay, I want to do the strategy session too. The strategy session is a nice bolt-on because the squeeze, the triple squeeze is kind of the squeeze on steroids. But at least you'll then have the foundation for it. All right, let's see what else. Is there an example where the sector fires long and the stock fires short? I'm sure there is, Anthony. That's one of those things that I have to look for and see. What I have found is that I have seen stocks where they fire off short and then immediately it turns around, and that's because the sector has fired off long. So the sector will actually carry the day and override the stock. That's one thing I've seen definitely. If you enter the squeeze before it fires, how do you know whether it's going to go up or down? So in the starter class and the strategy class, that's one of the big things I'll talk about is the tricks I've learned over the years for getting into a squeeze early. Because if you get into a squeeze early, the payoff can be much bigger. It can be a bigger multiple. And then there's ways to do it where if it doesn't work, your loss is pretty small and pretty contained. Tastyworks is they're at some point they're going to open up their platform for indicators, and we're definitely in talks with them. All right, let's see. And sector SPY. So the sector SPY measures the correlation of that stock you're charting versus everything else. That's how we found that Shopify stock at the beginning of the year. It's like, okay, so that's good for stocks that aren't part of the top 10 SPY, right, or part of the top 10 sectors. It's like, here's a stock that's just in its own planet. Okay, just scrolling through. Can this be used for FX related instruments? Yeah, no, definitely. Now I've not charted cash Forex on it, like dollar yen, dollar CAD, dollar pound. But I have done British pound futures, yen futures, and they're the same. I mean, obviously they're moving the same if some of them are inverse. Oh yeah, let me show you here. I'll show you. I see a couple people asking about the order page. So to order this, so you go to simplertrading.com/shadow. So you got to type in that link. Unfortunately, you can't click on that. But if you type in that link, it's going to bring up this web page here, okay? And then you can see there's a register now button at the bottom of each one. So you're like, all right, I'm going to try the strategy class. And then you click on that, and then you'll be good to go. And then if you want more description, you can go through and say, oh, okay, this is what the starter training includes, all right? And that's that's the central time zone there. And so anyway, there's a lot of data and stuff like there too, and you can see about the live event and things like that too. And that's all you got to do. But yeah, if you're ready to go, and I mean, look, this is going to be a great class. And if you're ready to go and want to knock it out, yeah, you just come down here and just pick your journey. All right. That's nice. Pavlin's was saying, hey, on the last class, I made 509% on the shop April calls. That was a good one. Robin, it's interesting. So so Tom Sosnoff and I know we talk, and I had a call with, if you guys know Christy, she runs the show there, and I've known Tom for 10 years, and so I've already told him point blank, like, we have got to get, if your platform is gonna work with traders, we need to get our indicators on there. And he's like, yeah, and he will. They just got to roll out. They've got a bunch of development they need to finish for execution. Um, so so um, but yeah, I'm in the process of that's definitely in the works. What is a relation between the SPY correlations indicator and the triple squeeze indicator? Okay, so the correlations indicator is there. That's measuring the relative strength in comparison with each other. So what you're interested there is that the stock that you're trading has the highest correlated strength. Okay, so that's just measuring strength versus each other, whereas the squeeze is measuring of all those 10, which ones are in a squeeze. That's telling you which ones are about to make a big concentrated move. So Keith, that's a good question. So with Vanguard or Schwab, they are not as flexible in terms of being able to add in new indicators. Although, we'd love to be able to do it. So we do have some web-based scanners, um, that we also can show you, that we can use, that you can actually scan for this stuff and things like that too, and then still be able to take the trade in your Schwab or Fidelity account. How to use the MTF with these new indicators. So the MTF is, and remember, it's funny because people ask like, oh my God, all these new indicators. But what's interesting is that as over time, as you learn more and more nuances about the market and you continue to refine your approach, then you just use specific tools for it's like, okay, triple squeeze, I'm looking for larger than expected move within these top 10 stocks. Great. Um, Strong correlation. I'm looking for stocks that are going to go nuts, like Shopify. Okay. So what about the multiple time frame analysis? So that's if you're trading one, you got one, like the S&P futures, and you're not looking for a squeeze. It's just when all time frames are bullish, you want to be long. And then as soon as one goes bearish, you get out, and you catch those ebbs and flows like that. Okay. And you can combine that too, obviously, with a squeeze and things like that. Yeah, good question. I received the Simpler Trading Credit Sniper toss scan instructions, and the video did not play on my computer. Yes, please let us know, and we'll make sure that we're sending you the right one. Yeah, so for the live trades, and is this correct? I believe this is correct, that when we're doing the live trades, that those will get texted out. Somebody beat me to death if that's incorrect, but I believe that's what we're doing. Marquis, this is all new to me. I am very interested in learning, but but I know nothing. So, hey, that's fine. We all start somewhere. If you know nothing, I would start here, and it is, I think the starter is perfect for that. You know, we're not going to talk about anything complicated. It's just like, hey, here's how the market works. This is why I like squeezes. You know, you may not understand, like, say, some of the terminology, but you'll at least get an understanding of how the market works and how it flows, and then decide, like, oh, okay, that's something I really want to dive into more. Yeah, I like tools. All right, guys, cool. All right, excellent. Yeah, Terry, yeah, no worries. I will go step by step. And honestly, that's why we do a class on Saturday. That's the time where we go through slow, step by step. This is how it works. So then when you're in a live environment, you know what to do. All right. All right, guys. Well, thanks for joining us. Good times. I'm going to leave this up here. I will put our office number, let's see, 512-266-8659 if you have any questions. And you go to simplertrading.com/shadow. That'll take you there. And for those of you that are joining us, I'm completely looking forward to working with you on Saturday. It's going to be a lot of fun. And you guys have a good night. For those of you in the room, I'll see you in there tomorrow.